Now, the basis of financial management are the same for businesses large and small, but the legal structure is different. Now, I'm going to look at four basic legal structures. You see them on your computer screen. We have the sole proprietor, we have the partnership, and we have the corporation. And finally, down here, we have the limited liability company, which is relatively new, that was dreamt up by attorneys. So let's go back, and we're going to start here with Jim that wants to set up maybe a jelly bean stand. And Jim's jelly bean stand, he's got to think about that if he does it as a sole proprietor just to get his feet wet, he's taking a lot of risk. And risk is always the number one thought here when you set up a business. It's legal structure. That means if a child comes and eats a jelly bean and chokes, he may be sued, and if he is sued and lose, he could lose all of his personal liabilities. The tax structure is quite simple. The taxes would be personal taxes, be part of his AGI. So let's say that he sold $2,000 worth of jelly beans, he would be taxed at $2,000. The next thing would be, what if he wants to increase his jelly bean stand or raise capital? Well, it might be difficult to raise capital because it's just himself, and the bank's going to say, well, how much is Jim himself actually worth if he goes bankrupt? And finally, one of the I guess pluses to starting a sole proprietorship is the regulations. There's very few regulations. Let's put regs here for Jim to have to deal with from the standpoint of setting up this business entity. So the next one's called a partnership. And really, with a partnership, Jim might decide. Now, here's Jim. He might decide to start a partner with somebody else, and there's a legal agreement between the two. So you have to go see some attorneys here for this legal agreement between the two. However, we have to think about, one, the risks. Not only are the risks still personal, you now take on additional risk, because what if your partner gets himself and does something they shouldn't do, and then you may be liable for that as well. The tax structure is very similar. The taxes, taxes are, again, on both of your adjusted gross income. The capital is still difficult to raise, although you have two instead of one. That might help a little bit. And again, the regulations are quite simple. Now, I will say that I have never seen partnerships really survive. The only partners I've really seen are those that are professional in nature. When I say professional, I mean the professional, jobs of being a doctor or being an attorney, a lawyer. So I'll just put lawyer. So I tell students if they want to start a partnership, and it's for the reason just to raise capital, I tell them to try to raise it on their own, because partnerships just don't work. The next one would be maybe Jim wants to start some type of C corporation. Here's there's Jim. There we go. And he was set up a C corporation. Now, C corporation was actually born in a court by the Supreme Court by John Marshall. A very interesting story. If you get a chance to look, it was 1819. So what a corporation is here's Jim. He's no longer seen as the business. The business becomes its own separate entity. So here's the business, which is maybe Jim's jelly bean selling shop. So if you stop and let's take a look at the risks. In this case, the risk is quite limited. The risk is now diminished, which is a good thing. This is the biggest concern when we start the business, is lowering the personal risk to Jim in this case. Now, here's some downfalls. First of all, the taxes. Since both of them are a separate entity, Jim gets to pay taxes, and so does the business. The business pays taxes on the income statement once a quarter, and then as the business pays Jim some dividends, Jim gets to pay the tax on the dividends as well. Raising capital is much easier, because now the bank looks at Jim, but no, it looks at the business. Finally, the regulations get quite extreme. Later on in a later chapter, I'll talk about how a company goes public, and you'll see a lot of the regulations, and it gets quite steep here. So the plus to a C corporation is the risk. It lowers the risk. Now, Jim has another option here. Jim might decide to open his business, if it's a small business, less than 100 owners, as a S corporation. And the difference is that this is under the C part of the book, and this is a few pages back or chapters back under the S chapter. So if he decides to do this, the business again is its own separate entity. Therefore, as I mentioned previously, the risks are reduced, which is always the number one thing. First and foremost is reducing the personal liability to Jim here. But the second thing that is really interesting about the C Corp, if it's small enough, is the taxes flow through Jim. Therefore, the taxes are not double, but only single. He pays taxes as an individual, which is a good thing. Now, recently, this new form that was dreamt up by attorneys is referred to as a limited liability company. So if Jim wants to set up this Jelly Bean as a LLC or a limited liability company, it does basically the same as the S corporation, leaving a business owner, a small business owner, to make the decision between an S corp and an LLC. And I always say, if you're going to have more than one partner, an LLC might be better than an S corporation. But there's a lot of reasons why one would choose one or the other, and I would consult with an attorney before making that decision. But the risks, again, with an LLC, which is the number one thing we think about when we set up the legal structure of a business, the risk is lower. I'm losing that arrow. The risk is lower, and in addition, the income or the monies that we make, the taxes we pay on the money we make, is only taxed one time as well, because it's also a flow through. So really, if we want to summarize what we have here with business formation, if we look at these last three, they do a few things. Number one, they lower risk. And when you lower risk, you increase the value to your investors. Number two, if you can increase the amount of capital, like the lower three did, the C corporation, the S corporation, the LLC, you increase capital. You can also increase your growth opportunities, which is good, because growth opportunities will make more money. And number three, these bottom three here, with the first two, is if Jim passes away, you can kind of see the business might also pass away. But the bottom three here, it increases the liquidity to owners. You increase the liquidity, or how quick I can convert liquidity, my part of the business, into cash. That also increases the value. For instance, if I were to purchase maybe Disney Corporation, you can take a look. I wouldn't have risk to Disney being sued, my personal property. And also, it's easy for me to sell quickly the Disney shares, therefore it increases the value to the owner.